As usual, another great guest, but a quick diversion. You'll notice that our full name is the Marketplace for Health, Wealth, and Freedom. Well, let's talk about your health for a moment. If you'd like to escape from the stranglehold of insurance and be able to see alternative doctors or go across state lines for care, then you definitely need to take a look at patientempowerment.mpb.health and see if that's the fix you've been looking for. Now, let's get back to the show.
Welcome, folks, to Freedom Hub's Health, Business, and Politics weekly webinar. I'm Charlie Froman, and Jim, my co-host, is with us. Jim, let me know if any of our other pseudo co-hosts join us. I know Dr. Wallen sees patients for urology while he sneaks back into the webinar to help us with these weekly events. And today is a good one. Obamacare, we've nailed that beast for a long time. We've had weekly webinars for 3 straight years, and we load them up on YouTube, and only a few of our interviews get canceled by YouTube, usually with the early treatment doctors like Zev Zelenko or Peter McCullough. We just had him 2 weeks ago and don't expect to find that on YouTube anymore. It was banned, I think, in 5 minutes. So we have backups at Rumble and BitChute and Brighteon, and we're looking at Library now too. And maybe Trump's new social media platform, if that ever gets off the ground. Full disclosure, like a lot of folks, we've had to get into the gig economy to make money, and I'm now a health insurance salesman, and I sell the Forbes featured alternative to Obamacare that John Goodman featured in Forbes a few years ago. And I'll share my screen to show that. It was this article right here. I'll put it in chat. If you scroll down to empowering benefits, 1 million people, mostly your local realtor agents, left insurance for medical cost sharing. And we created a mousetrap that allows for the health savings account, which free market supporters love. And I've had a really good experience over the past few years rescuing people from Obamacare, mainly because of the cost, the premiums, which is less of a problem now because of Biden's expansion of who gets subsidies. I've lost a few customers because of that. And I tell them, be careful, don't be blinded by the premium subsidies, because the deductibles still are $5,000 on average or higher. And most important, and I'll share, here's the article, deductibles, folks. You're still going to be effectively uninsured with Obamacare. The most important problem is this. Insurance companies use networks. Medical cost sharing companies don't, mostly. And Goodman featured this in Forbes. We have a concierge desk that's going to help you shop for drugs, tests, and specialists. And we'll use Healthcare Blue Book to help find quality. These insurance companies, to save money, are going to exclude the local doctors who are the top in their game. Centers of excellence, the top cancer doctors, they're going to be out of network, and you're going to get a surprise bill of some sort. So just don't get blinded by these fat subsidies. I know you want them. I know you need them. I know you think you need insurance, but I always tell folks, do you care if you go into a credit union instead of a bank? No, you don't. That market for credit unions has matured. Medical cost sharing has not. So folks still are brainwashed that only insurance can pay your medical bills. And that's probably the worst thing to use. I have a lot of sophisticated executives that understand that it's a waste of money to pay twice as much to access the same doctor. And that is our sponsor, the combo of sharing and HSAs. And Jeff Cannon will put the commercial on the YouTube when we get this loaded. But Peter Nelson was an advisor for Trump at HHS, Centers for Medicare Services. And with Brian Blaze, who presented here half a year ago, and Darcy Johnson and other friends we've had on here, they did great work during the Trump administration. They did what they could with a hostile Congress, liberalizing some existing law options, short-term plans, between job plans, HRAs, health reimbursement arrangements, which we're going to expand in a big way for the small group market. the idea is your boss can throw you the money so you can buy an individual plan on the market. And that's important for us because we do phase in pre-X. So we can't take all the sick people. So the Obamacare exchanges are going to become kind of like Medicare exchange for Medicare Advantage for all. It's going to be a sick person's platform. And with the ICRAs, the individual coverage health reimbursement arrangements, you're going to get a better plan sharing and increasingly that you can keep with you. So it's going to be very portable. And Peter's going to talk about that. And he works now as a senior policy fellow at the Center for American Experience. He's from Minnesota. Maybe you can talk about Scott Jensen, the doctor running for governor. He probably knows Twyla Braze. And I guess he can talk about the Mayo Clinic. I think that's from Minnesota, as a center for excellence that you can't get if you're going to be on these Obamacare plans. So we have a lot to discuss, Peter, and we're excited to let you take it away.
Well, thank you so much for having me here today. And yeah, I am from Minnesota. I work for Center of the American Experiment. It's a state-based think tank. And there's a lot of state-based think tanks around the country. And there's a lot of good people working for free market healthcare policies across the country at state think tanks. And I came from the federal government. I was working for the Center for Medicare and Medicaid Services as a senior advisor, mostly on these health insurance market issues. And we did do a lot of really great work to liberalize things, to remove regulations that didn't make sense, and to open up opportunities to make a more competitive health insurance market and drive more competition within the provider market space. But of course, there's only so much you can do at the federal level, and a lot of really good policy actually happens at the state level. And that's why I'm really happy to be back at the state level in a job where I can do kind of both, where I can really have an impact at the federal level and the state level, because certain policies do bubble up from the states. You probably are familiar with these right to try laws. And the federal government passed a right to try law, but that's only because the states acted first. And the states said, look, people should have a right to try certain treatments, even if they're not fully approved, if they're terminally ill. And that all kind of started at the state level. And then it bubbled up to the federal level. And so there's a lot of really good policy happening at the state level. And so you can never ignore what's going on in your particular state. And but today we're going to be talking about the individual health insurance market and how Obamacare has so far failed to deliver affordable, high quality health insurance through that market space. And yes, we've been talking about this issue since before Obamacare passed. Obamacare passed in 2010, and before that, conservatives were saying, "Hey, this isn't going to work," and gave all sorts of good reasons why it wasn't going to work. But nonetheless, the law passed, and President Obama in 2012, while he was campaigning, claimed that the law was going to reduce insurance premiums, and he claimed that by pooling risk with all these individuals, they're going to get the same good rates that people get in the group market by being able to pool that risk. And even before, in 2008, when he was campaigning, he was claiming, this was going to reduce rates by $2,500 for the average family. And we all know that didn't happen. And so before really getting into exactly what happened, I think it's instructive to kind of go back and look at the individual market from a more historical perspective. It's always been kind of a smaller marketplace across the country. And it's been, I think before Obamacare passed, there's about 11 million people in the market, which was about 5% of the entire under 65 population. So not very big, but it was still a very important market for the people who needed it, for people who didn't have employer-sponsored coverage, and for people who didn't qualify for Medicaid or Medicare. So still a very important market, but people recognized it had some problems. People always complained that it was too expensive. They complained it was too hard to shop for individual insurance policies. And they also complained that people could be denied coverage. And that was absolutely true. If you had a pre-existing condition at the time, you could be denied coverage and most usually put into a high-risk pool. But there were some issues with the market. And when people looked at what to do with the market at that time, liberals and Democrats basically thought, well, we just need to do some regulatory fixes, and that'll fix that market, and that 5% of people will have access to good coverage if we just impose more government control over the market. Now, Republicans and conservatives, on the other hand, had a much bigger vision for the market at the time, and they recognized that competitive markets need individuals choosing choosing the product or service freely to work. Competition depends on individual shopping decisions. And so Republicans saw the individual market as a place where if we expand this market, we can actually expand a market-based approach to buying health insurance compared to the employer-based approach that we had always been working under, or the government-based approach, where the employer, once you get a job, the employer chooses your insurance for you, or if you're on Medicare, the government provides your options. If you're on Medicaid, the government provides your options. The individual market was the place where we could build a real, true competitive market that drove costs down and quality up, like we see across every other market sector in our economy. And so we got to that point historically because we always had a tax preference for group-sponsored coverage through your employer. And so a lot of Republicans at the time, McCain included when he was running, argued for a fixed tax credit, moving away from the employer-sponsored tax advantage to basically a fixed tax credit for buying insurance coverage on the individual market. When we were debating the ACA, Paul Ryan and some others presented some similar ideas, but of course the ACA passed, and we never got to see that happen. And instead, we are now working through the ACA, and the ACA was passed, and it basically included a number of fixes, and these are small fixes. These were just fixed the individual market and really didn't have a bigger vision beyond that again. And so it improved affordability by creating these very generous premium subsidies depending on your income. And it also sort of helped you shop or claimed to help you shop through insurance exchanges, which when we were talking about it back in the day, they said these are going to be the Travelocity, the Expedia of the insurance market, and it's going to make it really easy to shop. And it also addressed the pre-ex issue for people because it required insurance companies to guarantee coverage if you have a pre-existing condition, and at the same rates as people who are healthy. So that was the ACA fix. And so where are we today? We're now in the 9th full year of implementation. And today, after all those regulations have now sort of worked their way through and sort of found their equilibrium, the left and the right still agree that insurance is unaffordable. Now, Republicans, of course, have been arguing that insurance is unaffordable this whole time. But now we see Democrats recognizing this issue, which is why the American Rescue Plan included a provision to expand the premium subsidies to higher income people above 400% of federal poverty. And so we know that it's not working. And so right now I'm just going to dig into a few spreadsheets or a few PowerPoint slides to really explain what's not working here. And I got to be able to share my screen first. So bear with me here. Let's see. And all right, so here we have a slide that shows the premium change that happened over the course since Obamacare passed in 2010. Premiums before 2014 were right in the low to mid $200 range, and that's the average premium people paid on the individual market. And then in 2014, that's when all the major regulations kicked in through the ACA. These are the major regulations that guaranteed coverage to people pre-existing conditions and did all sorts of other things to regulate the market space. And in that first year, premiums jumped up from $242 to $352. It's a big jump in just 1 year. And then we saw things start to go up again in 2016, and then even more in 2017. And by 2018, premiums had jumped to $588. And here's an important point to make on this slide. Premiums really jumped up. I mean, they had almost doubled by 2017. And this is under Obama. This is not a Trump. Trump had no control over premiums at this point. And this starts representing the crisis that we were facing when those of us who took jobs in the Trump administration had to deal with. The market was in crisis at this time, and premiums had skyrocketed. And it wasn't just a premium issue, though. This affordability issue isn't just about premiums. And we heard earlier about how deductibles and other cost-sharing elements play a role. This slide is from a Centers for Medicare and Medicaid Services report that was published right before I left the administration. And it shows sort of the extreme situation for people who are over 60 and have to basically pay out of their own pocket, who are above that 400% of federal poverty threshold. And that's about $50,000 for an individual. And it shows that once you get over $50,000 here, all of a sudden the premium, if you're in one of the highest cost areas of the country, and this is we measured it by quintiles, like the top 20% of counties. This is the average premium for the highest cost 20% of counties across the country. Premiums were 35% of your income when you're just over $50,000. And then when you add on top of the deductible, which was, if you had to pay the whole deductible, that's 10.5% of your income. And you add on any additional out-of-pocket spending through co-shares and everything, that's another 5.7% of income. It all adds up to over half of your income is devoted to your healthcare expenses, and that's before taxes. And this is plainly untenable for people. And so it's clear what's driving Democrats to expand premium tax credits above 400%. And it's also now clear, I think everyone should agree, why it was so important to repeal and replace Obamacare back in 2017 when we engaged in that exercise. And this slide moves on to show a little bit about individual market enrollment, because a lot of people will tell you, look, we at least have the subsidies and people still can access affordable coverage through the subsidies. And that's true, but this has been a very expensive process, or a very expensive thing, very inefficient thing to put in place when you actually look at the dollar amount it costs to add one more person to the individual market, because you have to net things out. Yes, more people were able to get subsidized coverage, but because of those premium increases we just looked at before, premiums went up so high that it became unaffordable for higher income people. And the unsubsidized people who buy coverage off exchange started to drop. And it's very clear it started to drop when premiums started to go up. So in 2015, the off exchange market was at 8.2 million. It drops to 7 million. In 2016, 5.2 million. In 2017, and it drops to 4 million in 2018, and it keeps going down. And the exchange enrollment, subsidized enrollment, sort of hit an equilibrium very quickly, right around 9 million people, and that never changed. And so year after year, we're seeing people leave the individual market at this point. And this slide goes to show the inefficiency of that. So this is basically the net change in the individual market, and the number of people in the individual market. And it looks at the cost per additional enrollee here. And because it starts to drop in 2016, that cost starts to grow up. And so this is the cost of basically the premium tax credits and the cost sharing reduction payments that go to subsidized coverage. And to get one more person in the individual market in 2019, it rose to cost about $20,000 per person. And that is clearly an inefficient way to run a healthcare system. And it really proves how inefficient the Affordable Care Act was at bringing people into the individual market space. And this slide is maybe a little bit hard to see and understand. I bring this slide in because a lot of people talk about death spirals. And people who support the Affordable Care Act claim that there were no death spirals, and the enrollment still sort of held steady. But enrollment only held steady because people had heavily subsidized health insurance premiums. If you have a portion of, say, Nordstrom's that has products that are completely free, that part of the department store is always going to have customers if it's free or very low cost. But the people who actually have to pay the full price for the clothes you get at Nordstrom's are going to start to drop off if prices go up too high, and that's what we're seeing in the individual market. And you look up here at Iowa, up here in the top corner. This axis is the percent change in premiums per member per month. As premiums went up, and they between 2016 and 2017, and they went up over 120% over that period of time. Enrollment dropped by 90%, and this is the change in enrollment. This is minus 90 right here, and so you had a 90% drop. That is a death spiral for the unsubsidized, and there is no other way to talk about that. The unsubsidized portion of the Iowa market was killed by the Affordable Care Act. Nebraska up there in that corner was also undone, and we kept seeing that move to that direction. And so what are happening to these people? These people went uninsured. And this is also from another CMS report that was put out right before I left the administration. And it shows that people with incomes above 400% of poverty, the people who don't qualify for subsidies, are the people who actually were paying, who were leaving the insurance market and just going uninsured. Between 2016 and 2019, 1.1 million people left the insurance market that were over 400%. And that's among a total of 1.6 million. So the vast majority of people going uninsured were these higher income folks. And I'll get back to that other slide a little bit later here. But I'll stop sharing and then just sort of move on a little bit to talk about like why that happened. I mean, the premiums went up and deductibles went up, and everybody kind of understood it was going to go up. Actuaries told us this was going to happen before the law was put in place. We closed state high risk pools, which dumped a number of sick people into the individual insurance market, which we knew was going to raise premiums. We had the guaranteed issue, which allowed people to go in and out of the market if they were sick a little more freely, which meant that you had a sicker population, a higher cost population of people in the individual market. And then you had health insurance benefit mandates that included a lot more benefits that added expense to it. We had health insurance taxes. We had an exchange user fee that got put in place. And one thing that's often gone unnoticed is that the premium subsidy structure of the Affordable Care Act contributed substantially to the increase in premiums. And that's something that sort of was kind of going under the radar for a long time until just a couple of years ago. And the premium subsidy structure is very important because basically the way it's structured is if the premiums increase on the exchanges, the federal government will subsidize 100% of that premium increase because the premium is based on the premium for the second lowest cost silver plan. So when that second lowest cost silver plan goes up, the subsidy goes up. And it's largely based on the fact that it's tied to your income. You can never pay more than a certain percentage of your income. And so so if you're already at that certain percentage of income and the premiums go up because your portion can't go up because it's based on the percentage of income, the federal government covers the entire portion. And insurance companies know this. And because insurance companies know this, they have far less incentives to control costs. And that incentive structure starts to deteriorate because the only incentives that drive them are the incentives tied to the unsubsidized market. And based on the information I gave you before, we see that the unsubsidized market is declining. So you're having a declining portion of the unsubsidized market and an increasing portion of the subsidized market who don't care about the cost and who are fully subsidized above a certain percent of income. And we see that premiums just kept going up and up and up. And so that leaves us where we are today. And so the Biden administration, they were fully supportive of the American Rescue Plan that introduced basically an expansion of the premium tax credits that made it more generous for certain people at lower incomes. In fact, gave basically $0 premiums to people up to a certain percentage of income, and then expanded it above 400% and basically tied it only to your percentage of income. So everyone who's forced to pay anything over 8.5% of their income gets a subsidy to cover that extra cost. And there's all sorts of problems with this approach because it basically builds off of the dysfunction of the Affordable Care Act. By extending that premium subsidy structure above 400%, it basically it continues to drive premiums up, and it adds more people who don't have any sort of premium sensitivity and are just basically relying on the government to pay any extra cost. And so that's really problematic from that perspective. And it also does nothing really to address the fact that deductibles keep going up, cost sharing keeps going up. It just keeps building off of the same system we had before. And a lot of people now are starting to recognize that doesn't work. And there's some other issues with that because premiums are now subsidized above 400%. There's less reason for employers to be involved in the situation and finance the healthcare. And so we saw the Congressional Budget Office, which basically showed that when you combine losses in the individual market, with changes in the individual market, with changes in the employer-sponsored market, you would see 1.8 million people lose private insurance coverage. And those people are then basically going into a government program and forced into that one-size-fits-all approach to healthcare. And really ultimately, it's just gonna, as I mentioned before, premiums are gonna go up. We have a huge problem with just the overall cost of care. Without competition driving providers to lower costs, without competition driving insurance companies to lower costs, we have a huge problem every year with the cost of healthcare rising faster than inflation. And right now it's at about 18% of GDP is gobbled up by healthcare costs. And that just keeps going up. And until we really make some fundamental changes in our healthcare system, that's not going to change. But that's exactly what Build Back Better is going to do. And if Build Back Better actually comes to fruition in some other smaller form in the future, which I think we heard from Manchin that maybe that's not going to happen yesterday. But if it does, we're just going to see costs go up and nothing change. So if we do want things to change, I've put out there a few ideas to put us on a better path forward. And those are built of around 3 different steps. And the first step is to move from this price-linked, premium-linked subsidy to a fixed subsidy. And this is really very similar to the approach that McCain put forward and a lot of conservatives had put forward back in the day, where we basically were going to give a fixed subsidy that didn't have this automatic inflator every year. And so if you were able to hopefully fix it at say $200 a month, insurance companies would know that's not going to change the next year, and they wouldn't be as free to increase premiums. It would have a huge impact on that cost inflator that's right now built into the Affordable Care Act. And it's something that that conservatives have been talking about doing for really decades. And we just need to move in that direction to remove that inflationary aspect, because we just know what happens in every other sector when you subsidize health insurance or when you subsidize something. We see that in college tuition. We see that in mortgages, in housing. It's just if you subsidize something, it gets more expensive. And that's exactly what's happened with health insurance. And so that's one policy approach. We should also put in place a federal reinsurance program. And reinsurance is a program that pays for high cost claims for people who have some sort of expensive health conditions or have an emergency situation during the course of the year that ends up costing more than they otherwise would have expected. And this is something that is an approach. It's basically a behind the scenes approach to the high risk pools that we used to have years ago that treats people with pre-existing conditions a little more seamlessly than we did before. And it also is appropriate for the individual market, because the individual market right now, because of the ACA regulations, which aren't going away in the near term, those regulations do make a sicker pool, and it helps equalize the risk pool between the group marketplace and the individual market, which is why I would want to see the individual market and the group market sort of the claims experience equalized to make it a more fair situation. So people who are unsubsidized in the individual market are not bearing this huge burden of having to purchase coverage on this much sicker pool than their neighbors that have an employer sponsored plan. And this has been effective through waivers from Obamacare in different states. I'm living in Minnesota right now. Premiums are about 20% lower in Minnesota than they otherwise would be, because we have a reinsurance program in place. And it's not the ideal solution, but it is a solution that I think people should consider, considering the regulatory framework we live under right now. The last thing I want to mention is health reimbursement arrangements, which were discussed in the introduction here. Health reimbursement arrangements is something I've got a big passion for. It's something I worked on before I went to work for the administration. I really kind of led the legal analysis of this issue and challenging what the Obama administration was doing on this issue, because they had basically said no business can pay an individual insurance policy with pre-tax dollars. In fact, they actually said you can't even pay it with after-tax dollars eventually. They got that extreme with with their proposals and their regulations. And we opened that up through the Trump administration. We allowed employers to fund individual market coverage. And this gets to the broader vision for what the individual market might do for insurance and healthcare costs overall. Because if you have more employers participating and you build that market and you grow that market, you're gonna have more individuals participating, more individuals using, deciding how much healthcare should cost for their family. And insurance companies are gonna have to respond to that cost pressure. And they will respond with lower costs. And so with that, I think I have gone on for about a half hour here. And so I think it's probably time to open it up to questions and comments.
It is, Peter, and that was fantastic. I'll start with the questions, and folks, as you see in chat, under reactions in the menu for Zoom, you'll see the raise hand icon. If you could just click that, and we'll get the queue going. And after I'll ask my question, I'll invite Hunter Schultz to ask his question about the minimum loss ratio, if you want to think about that as a big corporate welfare thing that insurance companies got out of Obamacare, which adds to the premium subsidies problem you mentioned. For that $200 fixed subsidy for insurance, as I mentioned at the beginning of the show, a lot of those wealthier individual market users you mentioned leaving Obamacare did get protection just through insurance alternatives that John Goodman wrote about in Forbes, including my company. And they're happier there, and they're not going back to insurance because we don't use networks. So when you get sick, you can go to the Mayo Clinic, which you can't do under a lot of Obamacare exchange policies because they impose networks that exclude the best doctors who won't agree to their low reimbursement. Whether it's health savings account deductions for DPC or insurance or sharing, or a fixed subsidy for sharing, how is knowledge about sharing growing with the free market community? It is new. I didn't know about it. I was there in the early 90s working for Republicans on Capitol Hill fighting Hillary Care. I didn't learn about medical cost sharing. It has been the religious sharing ministries, but now with Sedera and Zion, it's secular now too. And small group, it's individual, it's exploding. In fact, Sedera is the fastest growing company in Austin, Texas. People love sharing better than insurance. Is the community, I'm part of the Repeal Coalition listserv in DC. Is the community learning about sharing, or is it still marginal and not much is known about them?
Well, I wouldn't call it marginal. It's one of the options out there to find affordable health coverage, and people are desperate to find affordable health coverage if they don't have access to heavily subsidized employer-sponsored coverage or these other subsidies. And it's one of the reasons why we in the administration expanded opportunities to buy short-term health plans. And so I've sort of put the sharing ministries in that bucket with short-term health plans because it is a lot more affordable to people. And but the good thing about sharing ministries and some other options out there, like Farm Bureau plans, these are some other plans we can maybe discuss, but these sorts of plans are individually, you do have to go through some individual underwriting in regards to these plans, but it basically provides similar benefit structures and similar benefit amounts as regular insurance. And you don't hear people complaining about being cheated by the insurance company with these types of coverage. We do hear some stories about short-term plans where we've got some bad actors, some bad apples in that market space. But when it comes to the healthcare sharing ministries and when it comes to Farm Bureau plans, you don't hear those stories. And so I think it's been a very attractive option for people because it is affordable. It doesn't come with the huge cost inflation that you get with the Affordable Care Act plans.
Thank you for that. Hunter, do you want to unmute yourself and raise the MLR controversy? Hunter Schultz, are you there? You want to unmute yourself? Well, I'll ask it for him. You saw it in chat.
Oh, he just went on mute, I saw.
Go ahead, Hunter. Your chat question on minimum loss ratios. You want to ask it, or you want me to ask it for you? Well, he can insert himself if he wants, but you know about that controversy, right, Peter?
Yeah, I mean, yes.
Go ahead.
But go ahead and ask your question. Maybe I don't know your exact angle.
Well, while Forbes featured me for helping others disrupt the small group individual market, people like George Classen, who's on here, these Rosetta type advisors, they're disrupting the large group market with self-funding and direct contracting. And a lot of them are really high quality advisors, and they consistently nail the minimum loss ratio that because of the shareholder profit motive drives insurers to not worry about overcharging because it helps their profit, because they have limits on individual profit. They have to make up for it from volume. I wonder if you guys have thought about the unintended consequences maybe of the MLR.
Well, yeah, absolutely. So the MLR, I mean, it's one of those parts of the Obamacare that sort of moves the health insurance market into a regulated utility sort of thing, like your electricity or your natural gas. Electricity and natural gas companies basically are allowed to make like a 10% extra off of the cost of their of delivering your energy for you. And so they have no incentive to reduce the cost of your energy, because they actually have every incentive to increase the cost of your energy because they get 10% off of a bigger number. And that is what we see with MLR. MLR requirements require health insurance companies to basically on the individual market to pay out 80% of their claims in premium, and it really kind of solidifies this percentage of profit that they can get. And that percentage of profit is just okay. That's the way it works for them. And so they really, it sort of creates this situation where if premiums go up, they're always going to get that percentage of premium, and they can always adjust their premiums from year to year to account for that. But what we've seen, the whole idea is that, the reason why it's in the Affordable Care Act, people claim it actually helps consumers because insurance companies can only profit so much off the MLR. They can only profit up to, they can only take 20% out of the total premium to pay for their administrative expenses and profit. That's what the claim is. However, there's all sorts of research out there right now that shows that insurance companies adjust the claims number on that medical loss ratio. So again, the medical loss ratio is a ratio between the amount they pay out in claims and the amount that they pay out in administrative costs and profit. And so the idea was to limit the administrative costs and profit. But what we've seen is that insurance companies, if they're having an issue with their medical loss ratio, they just increase the claims amount. So actually they pay out more to providers to adjust that ratio, and which only goes to drive up premiums. And so the research is clear on that point. It hasn't worked. And so, I mean, I would be all for putting forward federal policies to get rid of MLR. And it's probably a good metric for consumers to have a transparent understanding of how their health plan operates, but it shouldn't be a requirement.
It reminds me of the 90s when I was lobbying for the mortgage brokers and there was a class action attack on how brokers got paid by wholesale lenders. So to your point, maybe educational for home buyers to know how much the broker's getting paid, but absolutely useless to the total cost they're paying. And George, I don't know if you want to unmute yourself to talk about the struggle you, health or other type advisors are having, getting the CFOs to understand how badly that they're getting ripped off by the BUCAs. George, did you want to comment real quick on that? How the MLR and the whole insurance game is just really hurting price transparency and your work?
Yeah, absolutely. It's when somebody has a small piece of the pizza pie as their slice, the only way to increase their share is to increase the whole pie, right? So the carriers do whatever they can to let claims run. I mean, their TPAs, well, whatever they want to call it, it's not really TPA, but most of that stuff runs on auto adjust for certain amounts, say under 5,000. So providers know this. There's a lot of mistakes in there. Nobody checks them. People who actually do check medical bills find 90-something% of them have mistakes on them. Is it an accident? Who knows? But CEOs, my take on it is most CEOs in America just want to grow their business. They want to check a box. If they say to an employee, look, there's your Blue Cross card, go to work, period. They sleep well at night. They've been told that they can't do anything about the cost of healthcare, which is not true. And they just factor the increases in as the cost of doing business, and they shift as much as that onto employees, which means people who actually carry those insurance cards don't get care that they need when they need it, because they don't know what anything's going to cost. They've all been burned. So we call that being functionally uninsured. It's the CEOs out there who actually had enough of this. When you explain the problem and they're determined to find a solution, you can help them. They do a lot to you basically just cut all that nonsense out. You go direct to providers for as many things as you can, and you reprice claims, that charge masters and all that stuff, PPO discounts, biggest nonsense and corruption ever. You actually just say, well, we'll pay you Medicare plus a percentage, and most of the time they take it. It's still good money for them. It's a business decision. They'll rip off whoever they can all day long, and then when there's a little pushback here and there, they'll say, well, we'll just take the money and move on, nothing to see here. So when you find organizations with really strong leaders, there's a lot that can be done there. But the rest of it, like the MLR, everybody knows it's nonsense. It's still there. It's not going to change. The government's controlling the whole thing, and they're very happy with it. They're stealing money from taxpayers to get votes. That's why these subsidies have increased. People who have to go and find their own solutions, who make too much money to get subsidies, and they don't want to work for other people and get their crappy Blue Cross plan through an employer. They have to look at the alternative solutions, and that's where we see a huge interest now in people who said, well, first of all, I'm not going to give more money to an insurance company than I pay for my mortgage. And if there's a better solution out there and it works for me, I'm going to pay attention to it and learn about it. But it's a crawl, but at least there still are alternatives in the country available to people.
Yeah, and I'm hopeful that we're going to see price transparency regulations that we issued under the Trump administration carry forward and provide a lot of the information people need to make those responsible choices and to hold providers accountable for the pricing, hold insurance companies accountable for pricing. So I was one of the lead people writing the health plan transparency rule at CMS and managing that rule. And one of the things I really didn't appreciate before I started that process was how little employers knew about how much they were paying for their employees' health plans. I would always heard, I'm from Minnesota. Target is based in Minnesota. I'd always heard that Target, absolutely knows everything about their health plan, and they do. And because they're a big enough employer to basically get that information from the third-party administrator they use. Smaller employers don't have that sort of power in that relationship, and they don't know how much stuff costs. They don't know whether it'd be cheaper to steer an employee to one provider versus another provider. And so they can't set up these arrangements that are the lower cost arrangements that actually require some competition between in the provider space. And so that was really kind of eye-opening to me. And I really do think that if the Biden administration does what they say they're going to do and keep moving forward with price transparency, that in the future, hopefully, can open up some more of these opportunities that you discussed.
Peter, as my brokerage ramps up the ICRA for the smaller group market, working out the details of how to get the healthy folks into sharing so they can have choice and affordability. And we match it with a health savings account using a MEC, which is how most people do it in the market, or this new money doubling account. That's the fastest growing account in the market with us agents. The sick people, like you mentioned, the underwriting, they're not going to want to go into sharing if they have cancer, because we're not going to share in that first year, and we phase it in over a couple of years. They're going to have to go in the exchanges. So do you agree with a lot of agents who say the exchanges are basically going to be an expansion to Medicare Advantage for the younger folks? It's going to be for sick people with a subsidy. And are we trapped with Medicare for all indirectly through Obamacare? And then does it become even more important to push back and restore the state-based risk pools?
So moving back to sort of the state-based risk pools, that would be one of my preferred policy options, I think, going forward. And that's why I include sort of a reinsurance approach in my list of 3 proposals, because, kind of going back to the 3 proposals I put forward, a lot of those proposals are based on the reality that the Affordable Care Act isn't going away anytime soon. It doesn't look like it's going away. And so if you're operating under that structure, what can work? What can work? What can work better than what we have right now? And so I would prefer, I don't want to see the exchanges, and because when you talk about the exchanges, you're then talking about just the individual market itself, because it's a single risk pool, and if all the exchanges are doing is pulling in the cancer patients and other people with high risk, high costs, only subsidized people are going to be able to afford individual market coverage. And to me, that then sort of undermines the competitive element that I would like to see in the individual market. I still have a vision that the individual market can be a place that's competitive through an ICRA, where the ICRA is able to be used for the employer to fund all their employees' coverage, and which then can empower individuals to shape the individual insurance market in a way that is more affordable, and also then protects people with pre-existing conditions, so they can move from one group to another group. And I do see sort of relying on sharing ministries as sort of the second best approach. It's something that is absolutely necessary right now because there's no alternative to provide affordable coverage. I would love to see a future where you actually have a robust, competitive individual insurance market that's not sort of a coverage that exists only because it gets subsidies, but it's a market that exists because it actually works, that it delivers affordability and brings in a balanced pool of people who have high healthcare costs versus people who have healthy risks. And that's what I would like to see in the future. And I think we can get there with the right policies. But right now, these sharing ministries, farm bureau plans, they are absolutely necessary for people, and especially in particular areas of the country where you see plant premiums over $30,000 for a single individual. If you're in the 55 to 65 age category, that's just doesn't work, and you need alternatives.
It works for Blue Cross.
Yes, it works for Blue Cross if they're getting subsidies for it.
Yeah,
And
the problem is, I agree that you can actually come up with an individual marketplace that can be affordable, but it gets regulated to death. If we can do an individual marketplace nationally that runs on RBP, we've got this whole problem solved. We can put a pass-through PBM in place as well and stop getting ripped off by PBMs doing rebates through the back door, and then put a formula in place that's probably better than any Medicare Part D plan, Scott. And you can make a huge impact here, but every time somebody tries to do this, it gets crushed on by every regulator in every state, because Blue Cross goes knocking on the door and says, oops, this is competition, it's going to drive up rates. So they just crush it.
As an example of that, real quick, Peter, we're working with Del Shore, a Delaware insurer run by Abbas Bayat, and it's a genius insurance plan that really does away with prior authorization for the high volume, low cost expenses, and just looks at more expensive features. And he's been attacked by the BUCAs. So there are some ethical players for insurance out there trying to exist, but as George said, BUCA may be a cartel that just is not fixable. But we hope you're right. You want to respond to what George said?
Well, yeah, I mean, you're right. There is going to be this element of overregulation when the subsidies are structured the way they are and tied to a certain benefit structure. And I'll be honest, it's hard to get away from that. If the government decides to subsidize something, then it wants to make sure you're getting a good product. You can understand the dynamic there. And so you can understand why the government all of a sudden says, well, this is the type of product you should have because we're subsidizing it. And that's a hard dynamic to move away from. But I think if you do a fixed subsidy, that's hopefully one possible way to move away from that, where this fixed subsidy can go towards a broader set of policies, direct primary care combined with a regular individual insurance market policy in an easier fashion. The fixed subsidy can go to whatever healthcare you want, healthcare sharing ministry. It can go just to direct primary care if that's all you think you need. And that's what I would like to see happen. And then, ultimately it may be that there's ways to pull the regulation back to the state level or maybe a regional level, where it makes it easier to fight against the big insurance companies that are trying to keep the status quo. Because I think that's where you're going to have basically more success, especially in certain areas of the country. Yes, there's obviously states where these big insurance companies have everything locked down and you won't get very far. But if we can provide examples in other regions or other states where this can work, hopefully then it would push back against areas where you have these monopolies that really do have tight control over the insurance market space and are stopping basically progress. So I would hope that's where we could get to. That's I think that's obviously a long ways off. In the meantime, we have the healthcare sharing ministries, we have farm bureau plans, and we have hopefully some efforts at the state level to improve the individual market, so it's not as overregulated as it is right now.
Jim, you had your hand raised?
Yeah, two things. You hear me? Thank
Yep.
you, Peter. Can you put those slides or make them available? Some of the statistics you showed up later. I don't know if somehow pass them on so we can see them.
Sure, yeah, absolutely.
Okay, thanks. Second thing, to me, it's the whole insurance. Yeah, obviously the industry is messed up, broken. I see. What do you think about splitting into two pieces? I mean, to me, it's like buying Doritos. You know, they go on sale at the store. Well, I don't think Doritos are going to help me in any way. I'm not going to buy them. Health insurance, I see as it's the actual conventional medicine. It's great for emergencies, acute care, absolutely. But for health, you know, to stay healthy and to keep the patients healthy or people, it doesn't do that at all. So if there was like separated out, so here's either whether it's direct primary care or you see your acupuncturist every month, you know, and they can work out deals, but the idea is keep people healthy so they don't end up in these hospitals, right? Or having to use that. I mean, sometimes it happens, of course. Do you see any way to like split that apart, or is that a state thing, or, you know?
Well, I mean, you could either split it apart, and there have been people who have argued for that, where I think, what do they call it? They, you know, basically insurance for being exposed to a high healthcare cost. You know, you can have your regular health insurance, or, but then you can also just have health insurance that truly just is triggered if you get cancer, and all of a sudden you're having to pay a huge out-of-pocket expense. And but if you do that, that doesn't get to your health. I don't think that really gets to your health issue, that creating the incentives for people to stay healthier. I don't think that drives towards that goal. One other angle to this is that we're stuck in the system where insurance policies are written on an annual basis, and where you have open enrollment annually, where you encourage people to revisit their insurance plan option on an annual basis. And so insurance companies don't expect you to be around next year. And even in the employer space, where people are basically trapped in their employer plan, they're less trapped than they used to be, because people are staying at their employer for shorter periods of time these days. And so even in that situation, so people aren't in an insurance plan for very long, which means the insurance company doesn't have an incentive to manage your healthcare and to give you incentives to be healthier and to invest in your health, because they're not going to get a return on any investment in your personal health after 5 years. But if you could have a longer term contract, then you could possibly have, you know, that sort of arrangement where the insurance company actually cares about your health, invests in your health, versus what we have right now, where it really is a sick plan.
Right. And just to throw this in, I see Jane Dolan had her question in the chat. How do you think this all-cause mortality, which is skyrocketing because of the shots and everything else going on in terms of credibility, and how might this affect the industry down the road a little bit?
Just as far as credibility for who? Just as far as credibility
Well,
overall,
conventional medicine, I suppose. I mean, the regulatory agencies, but they're working pretty closely with the insurance companies, right? So.
Yeah, I mean, that remains to be seen. I mean, what you're talking about, I think, is sort of isn't talked about very much in the public, and the data is coming out, is just coming out, and no one's really had a chance to really understand what the data is. I think one thing you're probably referring to is the fact that life insurance companies are telling us that insurance claims for that 20 to 50-year-old bracket have just gone sky high over the past year, and we have to dig into the data to understand exactly why that happened, and so we don't know exactly why, but that's something I'll probably be doing here in Minnesota, trying to investigate what's going on in Minnesota. But yeah, I mean, I think that's right now. I don't see that much of a discussion in the public to change what's happening within these big systems. That may very well change if all of a sudden the data start pointing in a specific direction that suggests that that these systems have failed us.
Yeah, thanks. Okay.
And that concludes our webinar. I want to stay around an hour. Peter, why don't you tell us how we can reach you at the Center for American Experience and what you're working on next? Well, obviously the data, but go ahead.
Well, yeah. So I'm working on some of that data. I'm also working on I'm also working on a lot of like looking at what CMS is doing right now. They're trying to pare back a lot of the regulations that we put on the books, which is only going to drive premiums up higher. One thing I didn't mention, I didn't really get into what they're doing to pare back what we've done, because we did a lot of stuff to stabilize the health insurance market, to moderate premium increases. And they're pulling a lot of that back, which allows people to game enrollment and wait until they're sick. They've got special enrollment periods that just basically allow anyone that's low income right now to jump in the market whenever they want. And that's a problem. So definitely some working on oversight over what CMS is doing, and hopefully providing some helpful comments to steer that in the right direction. And at the state level, I really would like to see a lot of the states put in place are the transparency regulations that we put in place at the federal level, because we're not seeing hospitals comply with that. I think states can play a big role in making sure that those transparency rules are complied with. And so that's another thing that I'll be working on in the near term. And yeah, so that's sort of what's on my plate right now. So our website is americanexperiment.org. And so if you want to keep track of everything we're doing as a state-based think tank, you can go to americanexperiment.org, and we cover education issues, we cover tax issues, we cover the gamut, environmental issues. So we do a lot of work on that front. And you can reach me at peter.nelson@americanexperiment.org if you have any questions. Again, that's peter.nelson@americanexperiment.org. And so thank you so much for having me. It's been a pleasure.
Thank you, Peter.
So what about your wealth? If your money could actually talk to you, would you listen to it? Well, with the DNA Network Academy, your money actually can talk to you, and it's going to tell you just what it told this client. This family had over 24 debts, mortgages, car loans, the works. They were on track to take 20 years to pay it all off, and instead did it in 8.5. Plus, they did it without refinancing, making more money, or even changing their lifestyle. So find out for yourself with a free analysis that is completely confidential. No personal information, no social security numbers, no credit checks, none of that nonsense. But what is exciting is that the outcome of that report you receive is a guaranteed outcome for you. To get that report, head on over to bit.ly/debt to wealth. You will arrive at this simple form. Fill it in as simple as lender number 1 and credit card number 2. What really matters is the accuracy of your numbers. You'll be able to see that if instead of 20 years or whatever your number is, that you may actually be out of debt and on your way to wealth in as little as 6.3 years like this client.